Hello, I'm excited to introduce and thoroughly discuss a brand new, innovative, and highly relevant form of the GARCH model. And as is our standard practice, we will be making full use of our comprehensive and interactive website, which is known as the Finance Research Gate. The specific GARCH model that we will be focusing on and discussing in detail today is known by the acronym FIGARCH. This particular term, FIGARCH, actually refers to, or is an abbreviation for, the Fractionally Integrated GARCH model, a significant extension in financial econometrics. It is a commonly accepted observation that financial return series frequently exhibit the characteristic of volatility clustering. So, what we are doing here with GARCH and its other family members is not simply modeling the actual variable itself, but rather we are specifically focusing on the volatility of the error component. An unexplained component of the variable, what we refer to as the error part, it exhibits a certain degree of volatility, distinct shocks, and unpredictable movements within that error term. Our primary objective is to thoroughly study and then accurately forecast that. And typically, we observe that market volatility has a strong tendency to cluster within specific timeframes. For instance, extended periods of relative calm are usually followed by more calm periods. Conversely, times marked by high volatility often lead into further volatile periods. As a reminder, this is the standard GARCH model we're discussing. Here, the symbol H actually denotes the conditional standard deviation. Now, if your goal is to find the actual standard deviation, then you must take the square root of that H value. Consequently, the H itself is what we refer to as the variance. So, the conditional variance of the error term is determined as a function of omega, which is understood to be the fundamental baseline volatility. So we have the alpha parameter, which is specifically known as the ARCH term. This ARCH term is intrinsically linked to the current error shocks, as well as the previous error shocks, and also the variance of the lag terms. And in this particular model, it is a fundamental requirement that these specific coefficients must be positive. This condition is absolutely necessary to guarantee that the resulting variance will consistently yield a positive numerical value. Now, in the context of the FIGARCH framework, we are going to make a key assumption that the influence of the error term here will gradually decay. This particular dynamic unfolds quite gradually over an extended period. Specifically, when we consider the standard GARCH model, its fundamental structure dictates that we incorporate only a single lagged error term. This implies that we do not automatically account for, let's say, an error term from 2 time periods prior, unless we explicitly define and include such a component within the model specification. However, it is highly probable that just one instance of error lag and error shock will be quite sufficient. It has been observed in certain types of financial time series data that the associated error term, which represents the deviation from a predicted model, might not exhibit a rapid exponential decay. Instead, what we often find is that this error term tends to diminish at a much more gradual and protracted pace, following a slow path of reduction. So, having only one lag here may not be realistic in some cases because we may have a portion a little bit here. With the second lag of the error shock, and we might also observe a certain fractional component that is directly attached or perhaps emanating from the third error shock, which has been squared and so on. So, the specific ARCH term that we are discussing, as is commonly understood, is directly determined by the value of Q, which represents the exact quantity of time lags we intend to include. The FIGARCH model isn't designed for determining the Q parameter. Pause. This behavior is quite similar to what we see with the standard GARCH model. Pause. The standard GARCH, for example, will tell us precisely how many lags of the error term we need to consider, like 1, 2, 3, 4, and so on. It's the same situation with the GARCH term, specifically when we refer to P, which indicates the number of lagged variance terms we wish to incorporate into our model, as these can influence the current level of variance. The Fractionally Integrated GARCH model, or FIGARCH, doesn't primarily focus on determining the specific number of lags required for the ARCH term. Instead, its underlying principle is based on the assumption that a small yet persistent portion of the overall impact originates from previous shocks. So, you have the option to specify that particular value as being equal to 1, and simultaneously, you can then estimate the FIGARCH model, where you will have an additional third parameter that is specifically called D. So this variable, which we're calling D, is essentially the proportion that we aim to derive or attribute based on the unexpected deviations or the past error shocks that have occurred. For example, 0.4, this means that we're going to have a little bit from the first lag, a little bit from the second lag, and a little bit from the third lag, with these contributions declining over time. This could be, for instance, 0.4 for the first lag. This could potentially be 0.12. It could be observed here, for instance, at 0.06, and from that point, it then declined quite slowly. Therefore, even if you only have a single ARCH term in your model, the FIGARCH model is designed to take a fractional contribution from all of the past error shocks, and that, in essence, is the FIGARCH framework that we are presenting to you here. So the primary focus here is on long memory behavior. Given that it accounts for a fraction of the error shocks from the past, it's important to note that the FIGARCH model specifically pertains to this particular term alone. We're not going to delve into or connect that concept to the lagged variance. The FIGARCH model, however, is fundamentally centered around this specific term. So first, we need to establish a robust model that allows us to accurately estimate the error. And as we've done previously, we will be utilizing the return equation, specifically the mean equation, where the overall return is effectively explained by the average value. So let's consider a scenario where we have the monthly stock return, specifically for a particular time period, denoted as T. This return is essentially a function of the overall average monthly stock return combined with the difference between the observed return and the associated error, which when combined will give us the error term, also known as the residuals. These are the components that we intend to model, specifically their dynamic movements. This particular characteristic is primarily defined by its variance. And if you intend to construct a model for this specific variance, our approach involves determining the conditional variance, which is explicitly expressed and represented by the mathematical term h. So, the variance of the error term is denoted as h. If you take the square root of this variance, as I mentioned earlier, that will then give us a standard deviation. And if you then multiply this by the standardized normal shock, which we call z, that will ultimately give us the error term. So, for example, if you have a financial time series where the error term is observed to exhibit a high standard deviation indicates that we will normally encounter substantial error shocks within any given period of time. This is because a highly volatile asset inherently generates more significant shocks, movements, or fluctuations. It's a very fundamental and basic concept. So the whole concept of taking z and multiplying it by the standard deviation in order to calculate the error shock for any given period is quite straightforward and easy to grasp. Z is the standardized error shock, which is more precisely described as a standardized random error shock. This particular variable has a mean of 0 and a variance of 1. So, what we're attempting to do in this particular analysis is to precisely model the underlying volatility and the statistical variance of the error term. It's certainly worth mentioning this particular type of lag operator because it's frequently found in many textbooks. For example, when we encounter the term LXT, this specifically refers to the first lag of xt, which is represented as xt minus 1. Similarly, if we have L squared xt, this implies that we are looking at x minus 2, indicating 2 lags of xt. And in this particular case, we are dealing with 3 lags. So, for instance, we frequently encounter this specific mathematical form, and what that expression essentially represents is x sub t minus lx sub t, which then, you see, simplifies down to x sub t minus 1. And this naturally is precisely what we refer to as the first difference. If the current value is 10 and the corresponding lagged value is 7, then the resulting change, or the first difference, would be 3. Now, if you apply 1 minus L all squared, this means we're taking a difference and then another difference. Let's examine how this mathematical process works here. Now, if you were to carefully multiply this particular term, you would then clearly see that the result you obtain is xt minus L squared xt, which, as you can observe, directly corresponds to this specific component, L squared xt. And that is equivalent to x at time t minus 2, which represents 2 time periods or 2 lags behind the current observation of x at time t. And then, of course, in the mathematical notation, we see the term minus 2 times 1 lxt. This lxt term signifies the first lag of x at time t, which is essentially x at time t minus 1. Now, if you were to apply this specific formula, what you're essentially doing is finding the difference and then another difference. So the 2 that's mentioned here actually indicates that you are calculating the difference of differences. For example, let's imagine a scenario where we have xt as the value 10, then xt minus 1 is 7, and finally xt minus 2 is 5. Let's examine the primary difference, which essentially reflects the overall change. At this specific moment, its value stands at 2. We are progressing from this particular value of 2 to a new updated value, which is 3. Consequently, the resulting difference between these two values, moving from 2 to 3, indicates a clear increase of exactly plus 1. So, how is the rate of change progressing? In this particular example, it's a constant value of 1. This concept is precisely what we refer to as the second difference. It essentially describes how much the rate of change itself has altered. It's really important to become familiar with these specific kinds of terms, because doing so will be extremely helpful when we begin to study time series econometrics. Let's now return to the FIGARCH model, which primarily focuses on the D parameter, also known as the difference term. This particular difference term itself, when used in the FIGARCH framework, typically has a range between 0 and 1. If the parameter is set to 0, it signifies that there is no memory from past error shocks, and consequently the model will then effectively collapse into the GARCH type, the one we previously introduced.
So this is the GARCH type. Assuming D has a value of 0,
based on our model's determination, we've identified only a single arch component, and the GARCH specification we're using here is a 1 configuration. This specifically implies that we incorporate one arch term into our equation. And to reiterate, the arch term itself represents the squared value of the previous period's error shock. Furthermore, the GARCH term in this context refers to the lag conditional variance. The error shock is intrinsically linked to the variance, as variance itself is merely the average of these individual error shocks observed over a period of time. Specifically, an error shock represents the innovation, or the unexpected deviation, occurring within a particular time period. This concept forms the basis for models like ERSH, autoregressive conditional heteroscedasticity, and its generalized form GARCH. If the variable D is set to 0, then in this specific instance, we won't have any fractional components. However, if D possesses a numerical value, then we will certainly be introducing additional terms into our equation. If the value of D is 1, then we're specifically discussing the FIGARCH model. And in this particular scenario, we observe persistence. But what exactly does this persistence refer to?
the enduring influence stemming from a prior period's error term, which means that even if you specify one arch term, we still have effects from past error shocks because D here is significant. In the FIGARCH model, the parameter D is less than 1, which means it decays quite slowly, but eventually it dies away completely. So, as an example, let's just say that D was equal to 0.4. So, this particular term will then become 1 minus L, and that entire quantity will be raised to the power of 0.4. It's important to remember that L here denotes the lag operator. How exactly can we proceed to solve this problem using this specific equation? You then plug in the value of D and you solve the equation. Now, if you proceed with that calculation, assuming that the variable D is set equal to the value of 0.4, then the expression 1 minus L, when it is raised to the power of 0.4, will subsequently yield for you these specific terms. You will find 1 minus 0.4 L, and then you will subtract the value of 0.12. L squared. So these are the terms we're considering. And the fourth term, which we'll consider to be the final term, because the final term will approach a value that's very close to 0, so we'll stop our calculation at L, specifically L raised to the power of 3. Now you certainly have the option to extend this further, but once the coefficient value becomes negligibly small, then you can confidently stop. So when we take L and raise it to the power of 3, that operation will yield this result. And for our current purposes, let's consider that sufficient. Therefore, we'll effectively stop our calculations at L cubed. So, if we take 1 minus L and raise it to the power of D, 0.4, that will give us this form. Now, this L value, this specific component, is then multiplied. This entire expression, as it stands right here, will subsequently be multiplied by a distinct variable, which in general mathematical notation is commonly referred to as XD. However, in the specific context of the FIGARCH model, the particular variable whose memory effect we are carefully considering is actually the error term. So the error term would be the variable that is multiplying each one, or to be specific, the error squared. It's crucial to remember we're dealing with the error squared because the primary focus is on the innovation itself, regardless of whether that innovation is positive or negative. So, taking the error squared, and then if you multiply by that, that specific calculation will provide us with the full FIGARCH model. I would personally prefer to make use of this. This is our model, specifically is the FIGARCH model. You'll notice that in this case, just as we did with the standard GARCH model before, we still have the variance component here. As we've discussed before, we have the term omega, which represents the baseline volatility. This means that even if we don't have past shocks affecting the current level of variance, even if we don't have any past variance affecting the current variance, so that particular component is 0 and that other one is 0 yet, we still have a minimum constant baseline volatility. So what exactly is the key difference we're looking at when we move away from the GARCH model? This specific part, you'll notice, remains exactly the same, and this particular element naturally also stays completely unchanged. Moreover, this final component here, too, shows no alteration whatsoever. For the arch term in this revised structure, we no longer include a factor like, for example, t minus 1 squared. We're now encountering a more complex term. This is precisely the reason why the FIGARCH model becomes active. So similar to a standard GARCH 1 model, we still retain a single arch term and a single GARCH term. But the key distinction now lies in the difference, which was calculated as 0.4. How exactly can we determine the solution for this? Let's recall the term, the 1 minus LD component. We then solve that by expressing it as 1 minus a set of these specific kinds of terms. This is what this particular value here represents the term we're interested in. We'll then proceed to substitute this directly into our main equation and observe the specific mathematical formula that emerges as a result. So, We start with the expression 1 minus LD, then we'll take that entire quantity and subtract it from 1. This means we're looking at 1 minus the specific term that we had previously calculated and established earlier. Now, if we proceed to carry out all of the required mathematical steps and computations right here, the result we obtain will be exactly this particular term.
So 1 minus L raised to the power of 0.4, which is shown above, and it's also written again here, 1 minus 0.4 lag operator minus 0.12 lag squared operator, and so on. So if you take 1 and subtract this specific term, you can then proceed to rearrange the entire equation. Once that's done, you'll find yourself with this particular term. Following that, you simply multiply it by the error squared, and that result will be precisely this final term.
We're going to see this initial term change and become this new term. After that, we'll take the error value and multiply it by itself, squaring it.
What this means is that you're multiplying 0.4 by the error term squared. Specifically from the previous period, this then becomes the error term squared at time t minus 1. If you multiply this value by L2, what that signifies is that you're considering the error squared from 2 time steps prior, effectively a lag of 2 periods at time t minus 2. Similarly, if you multiply it by L3, this implies that you're looking at the error squared from 3 time steps back in the past, specifically at time t minus 3.
So you are going to have this term.
So what exactly will the arch model look like in this particular instance? Well, it's going to be quite straightforward. We'll have the constant term, which we denote as omega, and then we'll add in this newly introduced arch component. And of course, we must also include the GARCH term, which represents the previously observed or lagged conditional variance. All right, so that's the fundamental concept. This particular model is known as the FIGARCH. It's crucial to note, however, that the arch component has now grown considerably more complex. Previously, in a standard GARCH scenario, we were limited to considering just a single lag of the squared error term, and that was the extent of it. But now the concept has evolved and we don't use just one single term anymore.
Even though we initially specified this as an arch model of order 1, and despite the fact that the arch component itself is indeed 1, given that we have now incorporated the variable d, which inherently represents a fractional element, this then forces us to account for a fractional part of the lag error, and also to consider a much smaller overall fraction.
We are considering the influence of the error squared term from 2 previous time steps, and then, with an even more diminished impact, we account for the very smallest fraction, that same error squared term from 3 time steps ago.
This is precisely why I refer to this as a fraction, because at this point, we're no longer just taking a coefficient solely from a single lag term. Instead, we possess multiple lags and we are taking a fraction of them.
So, rather than summing all of that information into just one single term, we now have 3 distinct terms, each representing a different lag, and we then multiply each one of those by a specific fraction.
This particular model is known as the FIGARCH. We employ this approach when we anticipate that the impact of shocks will diminish gradually, instead of a sudden or significant reduction.
If the decay in volatility, which originates from past error shocks, diminishes very quickly, perhaps exponentially, then a single lag in the model is often sufficient to capture its dynamics. And in certain situations, when you estimate a GARCH model, you might find that the arch term itself will not even be statistically significant.
However, if you anticipate that the impact of these error shocks won't dissipate rapidly, but instead will diminish quite slowly over time, indicating a persistent volatility, then the FIGARCH model would undoubtedly be the most appropriate and effective choice for your analysis. So with that understanding, let's proceed to implement this model right now, utilizing the capabilities of the Finance Research Get.
We select appropriate time series.
And then we proceed to select on a monthly basis from the period of 2020 up to and including 2024, and then we will apply these settings.
For our demonstration, we will be utilizing the very same example within both the GARCH and eGARCH models, and specifically, that particular example involved the market return. So I will now proceed to select the median value here. Following that, I will then select the stock monthly return.
That is our specific variable of interest that we intend to model in the FIGARCH. Our primary objective here is to thoroughly investigate the volatility associated with this particular variable. However, before we can do that, we must first construct this essential variable, which is commonly referred to as the market return. So, when we proceed to select the stock's monthly return, this means we are looking at the return for each individual firm in each given month. Then we will proceed to aggregate this data across all firms for every single month. The specific aggregation method we're employing here is the median. While we could certainly choose the mean, for instance, the median value will inherently be much less exposed to the influence of extreme outliers. So if you choose to select median and then this particular variable, and if you leave these other fields completely empty, what that means by default is that you are effectively selecting all of the firms. After that, you simply need to hit the apply filter button. This implies that the process will determine a specific monthly stock return for all individual firms within every given month, and the chosen statistical method for aggregation will be the median.
So, when you consider all of these companies, what this implies is that we calculated the median of their individual stocks' monthly returns across all these firms for every single month. Consequently, we end up with a single data point for each month, and this specific monthly value then represents the overall market's monthly return.
We can simply refer to it as the market return. And then we simply click outside of the box. It will take some time for the system to properly reflect the new name, or perhaps even to create a brand new variable using that specific name. And then, as we continue to scroll down the page, we are presented with comprehensive data for the market's monthly return. Upon closer inspection, it's quite clear that we can readily observe the significant degree of volatility that fluctuates around its average or mean value.
Do you clearly see this prominent spike right here? The monthly market return, for instance, might only be around 0.7%, which is quite close to zero, and that's because we're looking at monthly frequency data. Therefore, the primary fluctuation we observe here is essentially the fluctuation present within the error term itself. Given that the mean is quite a small value, resembling a constant line very close to zero, therefore, these particular fluctuations we observe here, they actually reflect the underlying fluctuation, or indeed the error terms.
First, you'll need to scroll down to the specific time series section. It's the very last one you'll find on the page. Once there, please make sure to select the volatility and financial time series box. After that, you can proceed to select our particular variable. Just a quick note, we actually have the exact same variable, but it's listed under a few different names.
And here, within our family, we're presenting the FIGARCH. Therefore, let's go ahead and select the FIGARCH. So at this point, we no longer need to explicitly define the HR lags. That's because this particular model belongs to an entirely different family of specifications, so we can go ahead and remove it from our current setup. What we're left with now are the well-known ARC and GARCH components. This configuration is quite standard practice in financial econometrics. For now, let's maintain the orders at 1-1 as is commonly done. We simply don't possess any real leverage. This particular point is quite relevant for the FIGARCH model that we had discussed earlier. Now we'll introduce the new concept, which is fractional differencing. You have the option to leave this field blank, allowing the system or the application to automatically determine the optimal D value for you. Alternatively, you can choose to specify this value yourself manually. We should manually set this up ourselves to align with the exact example that we previously created, and then proceed to select point number 4. So once we have everything set up, then we can proceed with the run. But before we actually execute the run, it's important to note this is directly related to the Zevala, specifically the standardized random shocks that we had previously mentioned.
All right, let's focus our attention on this specific aspect. Could you please explain in detail what the fundamental statistical assumption is that underpins the characteristics of this particular distribution? Specifically, are we to understand that it adheres to a normal distribution, which is also commonly referred to as a Gaussian distribution?
We will proceed with that approach. However, if you perceive that the standard random shocks of the error term exhibit characteristics of fat tails, then you have the option to choose this. Or if there's even some noticeable skewness present, you can then select this particular setting.
For our analysis, we should proceed with the normal Gaussian distribution of the standardized random shocks. This particular distribution represents the Z variable, which is directly associated with our error term. Once we have made this crucial selection, we will then be able to accurately fit our volatility model. So, at this point, we are now fitting the statistical model by utilizing the mean equation. So, what we have here is the mean market return. And then the difference that we observe between each individual monthly market return and the overall average monthly market return is what we define as the error term. Ultimately, our goal is to model the volatility of that very same error term. So, in this particular model, we are considering the baseline level of volatility along with the specific parameters, namely phi, d, and of course beta. As you might already be aware, the beta parameter itself represents the lag variance, which is essentially the crucial Gaussian component of the model.
And in fact, upon closer examination, we can clearly see that none of these specific coefficients are statistically significant.
The main variable that we are considering here, which is related to the FIGARCH, is d. And it's important to note that d is not significant, meaning that we don't have
We need to assess any potential arch effects or the impact of previous error terms.
So if you were to set this particular variable to 0, considering that the value we currently observe here is indeed very, very close to 0, then these findings would not be considered statistically significant because the calculated t-value is simply too weak then.
If you substitute 0, the result will be 1 minus L, and then we get 1 minus 1.
That would be 0. So if you take 1 and then subtract 1, you're left with nothing. Then if you consider 1 minus 1, and then we add.
So since this expression is raised to the power of 0, the entire term will then become 1. And if we consider 1 minus 1, that result will naturally be 0. Consequently, when 0 is multiplied by this, the final outcome will also be 0. Therefore, this implies that our model will effectively collapse, simplifying it to just ht being equal to w.
And we also need to incorporate the GARCH component into our model.
If its importance is truly significant, then we will certainly arrive at this particular term, the exact one we encountered previously during our earlier derivation process, specifically when we made use of point 4.
If it was significant, then we are going to proceed to plug this functional form.
This one. So this particular calculation would be quite significant. We are simply taking 0.4 and multiplying it by the lagged error term. Then we take 0.12 and multiply that by the 2 lags of the error term, which is then squared. And finally, we're using 0.064 to multiply the 3 lagged instances of the error term, also squared.
And you can apply this equation quite effectively along with the GARCH model and the omega value. To be precise, that should be the omega w.
And this particular method will provide us with the conditional variance, a very important metric that we can then effectively utilize to accurately forecast the future volatility of the overall market return, which can be derived either from the mean equation or directly from the calculated mean value. So that concludes our session for today. Thank you very much for listening.